Okay, so we are red and turned red in a hurry there. Ouch. Joe Mazzola joins me, head trading derivative strategist, and Cooper Howard, director and fixed income strategist at Schwab Center for Financial Research. Joe Mazzola, tell me about that fade there. This is a frustrating week for stocks. We can't get anything right. Look at this. We're giving it all up.
Giving it all up, and I'm tearing up my notes and then taping them back together, and it's interesting when you think about the fact that there's $2.2 trillion of trade between the nations that are involved in the latest rounds of tariffs, and I think what's happening is the markets just got kind of caught off sides. I think there was this belief that there might be a 11th hour deal that was done, and that didn't come to fruition. And then, we had this bounce midday where it looked like now there's a Ukraine deal and that war might be over. And, we turned positive for a bit. But I think, what the markets really have to digest, and I think you can see it in some of the sector rotations today, Oliver. Banking, discretionaries, those are the ones that are getting hit the most. Why? Because recessionary fears are really starting to creep back in, and maybe it's not even a creep. Maybe that the door's wide open and everybody's kicking it down because to see the kind of the turnaround that we've had in the last couple of days, and just it's really interesting just to see how the money's flowing into the different sectors. IT tried to kind of save it today a little bit, but just wasn't strong enough to pull up the overall market as decliners outpaced advancers by more than 2-1.
Okay. I also need to correct myself. Technically, it's not a State of the Union, but it's a speech to Congress. I could keep calling it State of the Union. But this address to Congress, everybody's watching tonight. Like, I get it because right now there's a lot of, everybody likes to use the uncertainty framing, but I feel like there's not that much uncertainty from a more macro perspective, which we knew tariffs were the plan. We knew some of this other stuff was the plan, too. What I think, to Joe's point here, is really crucial, Cooper, is I don't think anybody really had in their plan our economic data falling off the way it has the last couple of weeks, with surprise indexes all taking a nosedive. It's not like we've had some major deterioration in the jobs data, the core of the stuff, but tomorrow's services. I mean, to me, for ISM, that has potential to be a big mover, the way we saw bonds move on the ISM manufacturing yesterday.
Yeah, what I think you're seeing is kind of a divergence between the soft and the hard data, Oliver. So if we look at the hard data, the actual data that's coming in, things continue to be holding up relatively okay. Now, does that mean that the future is going to look positive? Potentially not, because if you look at the soft data, kind of the survey data under the hood, consumer doesn't look too good in that sense. Things look to be deteriorating a little bit more fast than expected. I think that Joe really hit the nail on the head, and I want to pull out two themes that we're seeing in the Treasury market, and one is growth concerns, the other is volatility. So the market clearly is moving on the concern that growth isn't going to be as good as originally expected, and that's why you're seeing the long end of the yield curve start to move down in terms of yields. The other piece is volatility. And this is going to be a difficult one to navigate the market over the next coming months, or potentially even longer, as we try to parse out what is actually happening with tariffs, what's happening with taxes, what's happening with immigration policy, what's happening with a lot of these different policies that are coming out of Washington. Are they negotiating tactics, or are they actually policies that are going to be put into place and going to come to fruition? So I think that that's really what you're seeing in the Treasury market, and where we've seen a lot of kind of the moves in yields as of lately.
Okay. Yeah. The bond market seems like it had a little bit of trouble pushing that 10-year below 4.2, a little bit of spring in our step around that area, but just been pretty much a one-way train lower. I think that's Joe, too. I hear when cuts start to get priced back in, you start to hear some of that more positive commentary start to envelop the equity discussion a little bit as well. But, one of these times, I know there's been a lot of head fakes the last year and a half, 2 years, 3 maybe, basically since COVID. But one of these times, right, these bonds are going to be rallying and they're going to break out for the wrong reason.
I mean,
a non-bullish reason, a recession.
Yeah, exactly. That's exactly what you're seeing right now. I mean, the rally in bonds is not because we're getting more favorable data from CPI and PPI. It's not because inflation has been squashed and and the Fed has done its job and we're going to start seeing cuts. It's because there's a growth scare. And And it's amazing just how quickly the narrative can change, right? And we always talk about this idea of valuations, and there needs to be a catalyst in place. Well, maybe this is the catalyst. Maybe that growth scare and the reversion or the reversal of going towards growth and those names, and now kind of what you're seeing in the financials today and discretionaries. Maybe the catalyst is the idea that we don't know what the next 6 to 9 months is going to look like in terms of the strength of the consumer and whether or not there's a recession. It's not to be a fear monger, but it's interesting to kind of see how quickly things unraveled from a volatility standpoint. Oliver, you and I talked about this a couple of weeks ago. People had been preparing. So I think there's a reason that you're not seeing a 5 or 6% sell off in 2 days. And I think the reason is a lot of hedges were already in place, and the hedges were in place for March. Now, if you start to see some of those come off, as March starts to roll into April, it'll be really interesting to see if those carry forward, or whether or not this is kind of a short-term drop that you might see a bit of a short-term bottom. We hit the 200-day moving average. We bounced off of that, but we're kind of making our way back down towards it right now.
Yeah, not a good close here, kind of dropping it a little bit. The commentary from Fed officials, Cooper, what tone do you expect to hear the second half this week?
We would expect that the path that the Fed's going to be moving down is still a path of rate cutting. Now, how fast do they get there and how many times do they cut? I think that that's a big question mark, and that's going to be data dependent. I know that that's kind of the cop-out answer, but really that's what we've been hearing from Fed officials, and I think that they're going to take a more cautious approach to where they go with the destination. Now, in terms of what the market's pricing in, they're pricing in about 3 rate cuts. And to Joe's point, that really shifted quite substantially pretty quickly. It was that the market was pricing in potentially 1 or 2 rate cuts, but we've given a little bit of a move down in terms of where we're pricing in the number of rate cuts this year. So I think that's going to look ahead to kind of the big data report coming out this week, what's going to happen on Friday with the jobs report. My expectation is that if we start to see a deterioration in the labor market, then yes, that's going to increase the likelihood that the Fed cuts faster than originally expected.
We are far from done this week. Kind of feels like we're just getting going here. Well, I guess
Tuesday, Oliver.
It's only Tuesday.
Tuesday.
I guess technically that's definitely true. Oops, thought it was. Yeah, all right. It's been a busy day and a half here. Day and minus 1 minute. Thanks, guys.